welcome to the Wealth Doctor TV. Now you might be confused and be like, Wealth Doctor TV, I thought this was Evolve with Letty J. Well, we decided that we are going to rebrand simply because the naming part of everything, like my Instagram, my channel, my name, my stage name as the Wealth Doctor, was confusing a lot of people. So we're gonna rebrand our channel, and we just decided that we're gonna call it the Wealth Doctor TV. So from now on, when I introduce the name of the channel, you're going to hear me saying the Wealth Doctor TV. And it's your girl Gulani Temba, the Wealth Doctor. So today is the beginning of a very, very, very special series for you guys. So now normally on my channel, also before that, if you have not subscribed, subscribe, because we are about to begin something very, very amazing. Anywho, if you have not subscribed, subscribe, because we are about to begin something very, very amazing. And if you're a returning subscriber, thank you so much for your love and your support. All right, today is the beginning of a very, very special session, like I said. And normally I post finance related videos on a Monday, and then Thursdays is personal development or any topic or conversations that are going to contribute into you evolving into the best version of yourself. However, from now and up until the next 9 to 10 weeks, I'll be posting investment education videos every Monday and Thursday, just for this 10-week period. And then after that, we'll go back to our normal setting of Mondays are for finances and Thursdays are for personal development. This is just an investment special, and today is episode 1. And today on episode 1, I'll just be introducing you to what investments are, explaining investments for beginners and people who don't really understand how investments work, and they are interested in understanding it so that they can start putting away their money and making it work for them. So first of all, I'm going to start by defining what an investment is for the new subbies, because my old subbies, as you have seen from my saving versus investing video from my 4 pillars of financial education, I already explained this. But for the new people, because in this channel we accommodate our newbies, I'm going to explain it again. So an investment is you giving your money a job, is you putting your money where it's going to make more money for you. Now, this is Wealth School. We are teaching you how to create wealth, and you investing your money is a very, very big factor that is going to contribute into you building your wealth. So it's very important that you understand these concepts, which is why I'm taking 10 weeks every Monday and Thursday to explain these things. All right, so like I said, investing is you putting your money into work and giving your money a job. And the characteristics of an investment is that it has a high risk and it is long term. It is normally long term. So the most common types of investments, or should I say financial assets, are your stocks or your shares. Secondly, it's your bonds, and number 3 is your cash. Now, your stocks are more of a riskier investment than your bonds are, like in the middle. So they medium risk. And then your money market instruments or your cash instruments is low risk. So now we know that high risk means high return, and low risk means lower return. And also, if you're investing in something that has a higher risk, you need to do it over the long term. If it has a medium risk, you need to do it over the medium term. Then if it has a low risk, then you need to do it over the short term. So now, how long is long term? How long is medium term? How long is short term? So your short term is 0 to 3 years. That's where it's suitable for you to put your money in a money market account. If you're gonna do it for more than 3 years, then it won't be profitable. It won't be profitable for you. And then your medium term is your bonds, right? So your bonds is like from 3 to 5 years. And then from 5 up until 20 years, 25, whatever, is your long term, meaning you need to take advantage of high risk, right? Okay, now moving on, there's also alternative assets, or assets that are not financial assets. and you have your property, you have your commodities, you have your cryptocurrencies, you have your hedge funds, and so many more. So the other types of investments are not considered as the main or the common types. They're considered as to be an alternative investments to the portfolio that you're going to create with your shares, your bonds, and your money market account. Now, it is very important to take note of the fact that there is no one size fits all when coming to investing. Why? Because your goals, considering your goals, is very important. So just because the wealth doctor is investing in very high risk portfolios does not mean that now everyone who's following me or who is a subscriber to my channel must do exactly what I do. You need to look at your goals because people are different. First of all, you need to look at your age. If you are 65 and you are 35 and you are 21, you don't all have the same amount of time, and you cannot all afford to take the same amount of risk. And then the second factor is your personality. There are some people who do not prefer to take a lot of risks, so you need to consider your personality as well. You also need to consider the fact that you have children. Are you going to be building a house? Are you going to be paying your own fees? Because in as much as, let's say, maybe you and your friend work the same job, earn the same amount of money, your portfolios won't look the same because maybe your ages might be different. Even if not, your goals are not the same. Maybe your friends want a mansion, maybe you want to buy a hotel. So you can't have the same portfolio. Your portfolio has to be catered for your goals and your needs. Now, a lot of people think that investing is only investing in shares or stocks, but that is not true. There's actually there's so many types of investments, and I'm just going to list them down for you. Types of things that you can invest in. I wrote a list of, I think it's 16, but there's definitely more than that. But I'm just going to share my list, and I'm looking at the list because I don't want to miss anything. So the first thing that you can invest in is you opening your own business. So this is an investment because you are going to put your money in the business with the aim of receiving a profit. So when you open a business, you put your money in that business, you want that business to make a profit, and that profit is bringing you returns. So, and a business is risky because you don't know if people are going to buy from your business. You don't know what's going to happen to your business. You don't know if the roof is going to leak. You don't know if your business is going to be set on fire. So this is you taking a risk and hoping in the future, which is why it's considered to be an investment. So the first investment is investing in your own business. The second one is investing in the stock market or buying shares, right? And then the third one is retirement savings. So now this is an investment because it is long term, and over the long term, depending on where you put your retirement annuity or your pension fund, it's going to start. Let's say maybe you start when you're like 25. It's going to start with your long-term types of investments or your risky investments. And then as you grow older, the people who are managing your pension are going to move your investments into a lower risk as you grow older. So it's considered an investment because it's long term, and it also invests in equities, bonds, and money market accounts in as much as you are saving, because remember, saving is you putting money aside for future consumption. So in as much as, yes, you're going to consume the money that you're saving for retirement in the future, but it's an investment because it's long term, and it's going to put your money in the three common types of financial assets, and also property and other alternative investments. And then the fourth one is bonds. The fifth one is offshore investments. So offshore investments can be your shares that you buy in countries that are not your domestic country. So if you're a South African and you buy US shares, those are your offshore investments. If you are South African and buying Chinese shares, those are your offshore investments as well. So it's pretty much you buying shares but in another country. You're not only limited to buy shares in your domestic country. And then we have our cryptocurrencies, and mind you, all the types of assets that I'm listing here, I'm going to create different types of videos where I'll explain them in detail. So don't worry if I don't go into detail on something. So your cryptocurrencies, it's more of trading, but I'll explain that in a video. But it is a digital currency, but we'll go more into depth on that when I create the video. You can invest in property. You can invest in impact investing. You can put your money in a tax-free savings account, and a tax-free savings account can comprise of your equity, bonds, property, and money market accounts, depending on your risk and your goals, your risk tolerance and your goals. So like I said, I'll go through everything in a separate video. That's why this series is going to take 10 weeks plus or minus. Then the 10th one is commodities, your gold. The other one is your hedge funds. The other one is private equity. The other one is, this one is a surprise. So it's investments that you didn't know were investments. So those are the list of investments. And if I did not add something, comment down below and add the other types of investments that you are familiar with. I just shared all the different types of investments with you, and if you are familiar with other investments that I didn't mention in the video, please comment down below with what those investments are, so that you can help your fellow Wealth Doctor TV subscribers. We need to find a new gang name for ourselves since we changed the channel to Wealth Doctor TV. Anyway, moving on to other things. Now, there's something very, very, very important. And if I forget this while explaining what investments are, I'll be doing a very huge mistake. So, when investing, it is very, very, very important for you to diversify, right? So what is diversification? Diversification is you minimizing risk by putting your money in different places, or like the famous saying, it's putting your eggs in different baskets. So I'm going to be explaining what diversification is through an example, and I'll be demonstrating it with I created little baskets here. So I really hope after I show you what diversification is with my little friends over here that are here to help me, you understand better and you will be able to diversify your portfolio. So let's move into example number one. So now, example number one, let's say this is your investment portfolio, right? So the first way you can diversify your portfolio, remember I told you that we have the three common types of assets, right? You have your stocks, which is your shares, you have your bonds, and you have your money market or cash instruments, right? So let's say this is your portfolio, né? So in this portfolio, you need to diversify. So you are going to diversify by buying equities, shares. Equities are shares, equities, bonds, and money market instruments. So let's assume this is the shares basket and the pens are the shares. You put this basket in your portfolio. Now it forms part of your portfolio. And then you also buy bonds. And then your bonds are these ones, right? So your bonds you put in your portfolio. This is a basket of bonds. This is a basket of the bonds basket is already falling, so I don't know. And then lastly, your money market or your cash basket. There you have your cash basket. So the importance of diversification is that if one basket, for example, let's take the bond one because it fell when I put it inside the portfolio. So if one basket fails, you know you still have the other baskets to carry you through. Or maybe if some of the eggs in the stock basket fail, and then you still have something left in your portfolio. Imagine if you had put all of your money in the bond portfolio. What would have happened? They would have, and it was going to be a loss from your side. So this is a way of making sure that your investments are safe and minimizing the risk of losing your money. Now, example number two is you can diversify by buying different companies in the same industry. So let's consider maybe the supermarket industry, right? Let's say you have your portfolio and you want to focus on supermarkets. If you only just buy one supermarket, for example, you just buy ShopRite. If ShopRite shares fall, you are going to lose everything, right? But if you diversify and you have your ShopRite basket over here, then you have your Woolies basket, then you have your Pick n Pay basket, and you have your Spar basket. You know that if one basket falls, the other baskets are still there to keep your portfolio going. I don't know if you guys can see, but if you know that if the other basket falls, you still have your other baskets keeping you or giving you money. So this is diversifying through the same industry but different companies. But you can also diversify through companies in different industries. So let's say this is your mining industry, this is your property industry, and this is your retail industry. So if maybe mining is currently performing poorly, it falls. At the moment, you still have your retail and your, did I say property? Yes, and your property to keep you going. And then if this one falls, you still have the other ones to keep you going. Or if you acquire different companies in the same industry, but you still diversify through the different industries, you know that if these fall, these are still there, and you also still have the other stocks from the different industries. The other one is, let's say you always had a dream of being a property investor and you only want to focus on property. So now you can also diversify your properties. So let's say, for example, you want to diversify your property portfolio. These are your properties. So then you're gonna buy maybe, what is this, flats and building and offices. Then you're gonna buy student accommodations. Then you're gonna buy maybe residential properties, right? So you know that if this one falls, you still have these two to keep you going. If this one falls, you still have the other two to keep you going. If this one falls, you still have the other one going. Or maybe you want to diversify your portfolio by having your property industry, your stock industry, your bonds, and your money market instruments. That is also still a good way of diversifying your portfolio. So that was my way of explaining how diversification works. There's so many ways you can diversify your portfolio. You can even have your South African diversified portfolio, where in the South African portfolio you have your shares and your shares in different companies in the same industry and your shares in different types of industries. Then you have your bonds, then you have your cash, and then you also have your offshore investments, where you also buy bonds and shares from offshore types of investments. And you also have your properties in there. You also have your cryptocurrency, you also have your commodities, you have your hedge funds, private equity, and your basket is just full and full and full. And you know that should something fall, you have something to lean back on. Should the property market fall, you know that you still have your shares, your bonds, and your cash. Should the bond market fall, you know that you still have your equities and your blah blahs and your blah. Should the South African market fall, you know that you still have your USA and your China and your other countries. Should the USA fall, you know that you still have your China, your South Africa, your whatever. So that's how broad diversification is, and you can be as creative as you want with your diversification. And pretty much that's how investing and diversification works. So in as much as you are investing, remember that you need to invest in things that are more catered for your goals and your needs as a person, and don't just copy someone's way of investing, and don't just take all of your money and put it in one basket. And one basket can be the same shares, or it can be the same industry, because normally when things go bad in a certain industry, all the companies in that industry perform. Let's say you invest in mining and the mining industry is currently performing poor. It means your whole portfolio is going to perform poorly. But if you have different types of investments in your portfolio, you know that if this industry falls, I have this industry. Or let's say maybe the South African market falls, you know that you still have your USA market, you still have your China, still have your other countries. So that's pretty much how investing and diversification works. And I really hope that this video was useful, and if you found it useful, comment down below and tell me that you enjoyed and how I was able to help you. Do not forget to follow me on my social media pages, my Instagram, which is at The Wealth Doctor and at Wealth School with Letty J. Thank you so much for tuning in. Don't forget to share with your friends and your family. And until I see you on episode 2, Thank you for watching episode 1 and